Hi, welcome to this episode of Insurance VC, PE, and M&A. Today I have a special guest. He's a rock star in the industry, Michael Blankenship from Winston Strawn. How are you?
Doing well, thanks. Thanks for having me, Jeff.
Glad to have you on the show. And I know you from my past experience working with you. But if you can, give our audience who you are and what you do, and also how'd you get into this. So I'll turn the mic over to you, Michael.
Sure, yeah. So, as Jeff mentioned, Michael Blankenship here. I am a partner at Winston Strawn. I co-chair the capital markets group for the firm. I'm also the managed partner of the Houston office. I started my career in New York, uh, almost 17 years ago, and within that, I was doing a lot on the capital raising side, working with companies looking to either go public or ones looking in the private, just raising money in really industry agnostic. But over the last 17 plus years, I've come to do even more and doing quite a bit of M&A activity. Moved to Houston about 11 years ago. Worked on many transactions in the various industries, including the insurance industry, but also others like energy, technology, new media, and healthcare life sciences. So maintain quite a busy schedule working with all different types of clients. As a firm, we have about 975 lawyers. We work, internationally. We have several offices outside. So I work on transactions that are both U.S. As well as cross-border through Europe, Asia, as well as Latin America. And so maintain, a good amount of knowledge about different things that are happening. There's always macro issues that come up and do affect various industries. So gleaned a lot from working on all different types of transactions with all different types of board members as well as executives. And so I think it's been helpful to do that. So that's how I started my career in New York, moved down to Texas. But I do get out, California to New York, even Chicago where we're based. So I get up, try to avoid it there in the winter, but I do get up to Chicago. So
One of our past dealings, we were chatting about spec in the past, and many people brought up your name. We reached out to you. Your firm does spec for insurance companies.
yeah, we have, that's for sure. So we've done it where you've got two sides. One where they need the insurance, so working with brokers to get their appropriate directors and officers insurance, but also ones that are insurtech or the technology or insurance companies that you're well aware of that use technology for insurance, which has certainly become a hotter commodity. So your Hippo and other type companies using SPAC to go public as opposed to just going through a traditional IPO or direct listing. Oftentimes, the SPAC would offer a different type of go-to-market transaction, so they could have their pipe capital kind of locked down and be able to go through that transaction. But we'll work on from the get-go where we're working on SPACs and the IPO all the way to ones that do acquire the insurance company or ones where we represent the company looking to go public, and then helping as needed in state. A lot of insurance is state regulations and rules, and so if we have to work with that, we'll either work with somebody internally or work with kind of local counsel in various states to help it go public. And really, insurance, just like other capital-intensive businesses, going public, even though there's the public company overhang of some costs involved, is a good way for them to be able to go out and acquire businesses using the use of equity. And so that's why it's look at some of these insurance companies that do go public, and then part of the reason why they do that.
I'm sure you have a lot of clients that come to you with huge admiration, right? Like their goals are big, they want to go public. And how are you advising people say, hey, do we take the spec route now or do we wait longer period, go the traditional route? How's that conversation like?
Yeah, that's an excellent question. I think really when it comes down to being public, it's the public company readiness. It's 3 words. You have to make sure that your financial systems are set up, that you've got the right people, and if not the right people, make sure you're trying to find the right people, and then having the right board members as well as the committees formed for that company, and continuing to really make sure that you've got all the pieces in place so when you do ring that bell that first day and you have a bunch of different investors, you're ready for it. Because once you are public, you have a lot more obligations than you did as a private company. You have certain disclosures that you have to make that you didn't have to make before. You've got ongoing quarterly filings. If you're a U.S. issuer, you have that annual filing every year, and you have to work with your internal controls and controller and CFO to make sure you have the financials proper. And the public company under Sarbanes-Oxley, the executive, the CEO and CFO, or the principal financial officer, principal executive officer, are required to sign off on any financial statements, and so they also take risk to make sure that they're doing it right. So you have to be really public company ready. And so I think the initial question I have for those companies is, well, so what have you done to get ready to go public? Whether it is a SPAC or whether it is an IPO, you have to really understand your business. And I assume all of them understand the business, but they have to understand it in a way that puts a second hat on, where they're not just operating, but now they're having to reveal everything about their business and sell securities in the market, or they merge and they do a big merger, because a SPAC at the end of the day is two steps. It's really a business combination or a merger, and then you've got the listing, and so you become a listed company. And so you would hope at that point you've got all the systems in place, because the PCAOB, or the Public Company Accounting Oversight Board, requires to have certain procedures in place for the accountants. So they're always looking at you from an audit perspective. And so what does the auditor have? Are you ready to do that? And so, again, it's a big lift. It takes a lot of time. And so it's just really about being prepared.
Seeing like a bit of a freeze on spec the last 18 months, 24 months. If we go back to 2020, 2021, what was the turnaround time frame from engagement to when someone actually goes spec? What was that like back in the day? Thank you for watching this video. Now a quick message from our sponsor, MAV.
Thanks, Jeff. I want to let you all in on a secret that top producing agencies don't want you to know about. If you're in P&C insurance, you know firsthand how much you're getting squeezed by your call center. It's becoming less predictable and less economically profitable to scale. But here's the thing. The top producing agencies making over $100 million are not running their leads through a human-based call center. They're running them through an AI expert like MAV to qualify, quote, and hand deliver the highest intent qualified leads to your agents. MAV takes care of the back and forth, having unlimited 24/7 conversations with your leads that are personal and relevant so you can scale to the moon. Ready to ditch your call center and 10x your agency? We're giving the listeners of insurtech's $15,000 worth of credit to try MAV. Head to hiremav.com/insurtechs to claim this offer.
Going through a D-SPAC, I mean, even the IPOs, there was, to your point, in 2021, we had over 1,000 IPOs in the United States, which was 5 times the average. A lot of those were SPACs, and so those were moving really quickly, 2 or 3 a week. A lot of the D-SPACs were also moving very fast, 4, 5 months. The SEC was getting them through, and then you fast forward till June of 2022, and that's when the SEC came out with its proposed rules that really put a chill into the market. And that's when you saw investment banks, a lot of the bulge brackets, really pull back at that point, because the SEC proposed things like making sure the underwriters take liability for certain things that they weren't before. They didn't have to have comfort letters. They didn't have to do Section 11 liability, which really strict liability, which would pick up those bankers into the deal, which is high risk for them. They're not really investing capital into the deal. They're making capital. They're making money at the end of the deal, but during the deal, they're not really they're not underwriting a security. So that was the proposal. It didn't end up happening that they're doing that, because July of this year those rules were adopted without that particular rule. but that they were, to your initial question, it was 4 to 5 months, and now it's 8 9 months. It's doubled up. I think there's part of it's the market, to your earlier point, but also you've got pipe financing not as readily available as it was in the past. I mean, a lot of money was out there really signing up and locking these deals down. But at this point, it's not as easy to get it done. And we're seeing, an uptick in IPOs. We're seeing in the SPAC space, but we're also seeing some, de-SPAC deals that just take longer.
So this year, I was at ITC Vegas. The whole convention was AI, AI, AI. When you look at like typical insurtech, right? If it's MG, if it's carriers, velocity to growth, and most important, loss ratio. If you look at a software, anybody competing with Vertafore, Apply, Salesforce is ARR, right? You have like baseline of some sort between loss ratios, combined rate to ARRs. They say there's going to be tons of billionaires from AI. And we're probably going to get a lot of different answers on this question. Have you guys established a baseline of valuation for AI companies?
Yeah, I don't think I mean, to your point there, it's really hard to get that evaluation because two things. One, is it a true AI company, or is it just really white labeling technology and using that in its business? If you do have a innovative new AI type technology here in the legal world, we're looking for the right AI technology that does corporate documents, corporate stuff. And there are a couple companies out there that raise money, and they know that's proprietary to them. But they may use some, open AI in the background that I'm not aware of. But you've got a very difficult time here, really evaluating, knowing what the valuation of those companies are, just given the type of business it could be. Now, in the insurance world, there's the total addressable market is pretty large, as you know. There's all different types of insurance products sold, and so AI could help remedy some issues that in the insurance world. Because insurance is one of the oldest industries in history of mankind, and I think you've got an ability to bring in this technology that makes it a little easier to understand the policies, understand the claims and everything else that's out there to get a true pricing for an insurance policy.
All right. So the next question is going to be a little bit hard. If I'm a founder, I am in my Series C, Series D, right? And I am preparing for the horizon of going public. What are the questions I should be asking you if I'm sitting over here interviewing you or one of your competitor? What should be the founder look for when they're trying to figure out who's going to be the right firm to take in public?
Yeah, so I think the first question, without asking, is, will you be my trusted advisor? Will you be the one that you're reliable, responsive, practical in your advice? And would you help connect me and add value, give something to me before I can actually give this to you? And the answer for me is yes. I mean, finding connections, value add, and making sure that you understand that you could do a bake off with different underwriters, do this discussion and understand that we often will give free, seminars or free advice about it, give you any checklist, any information you want, and trying to make sure that we're providing value to the business before you get in there with the lawyers trying to get something that might be a little costly. But for me, I just want to make sure it's high quality service, and I feel comfortable about that.
Where do you see specs or just traditional IPO in general in 2025? I saw somebody on X listed all the potential companies that's going to go public in 2025. And he listed like a top 30 with top 25 list. And there wasn't a single insurance company on there. How do you see this next market?
I think there's optimism for the market, especially if you defang some of the regulation. And so it could be a lot easier for insurance companies, especially consolidating to go out and go public. I'm sure there's one or two out there that are sizable that will try to to go into the public market that will use AI, that will make sure, customers are satisfied, but also investors can find a return from it. So I think there's a lot of optimism going into the new administration that, has talked about less regulation. And so if you get less regulation, you probably will see a lot more kind of on the public side of things, not just private equity. I think, you see private equity buying this up, but also, those guys in the private equity world also need an exit at some point. Whereas the public world, they can hold the public stock for decades. Berkshire Hathaway or Buffett held Coca-Cola forever, right? So you can hold for a long time and see the long value of them, especially in insurance, where there's return on that.
Yeah. One thing you said earlier, I had a mental note about filling out your board when people go public.
Yeah.
How does a world investor look at that? Like, if let's just say I have a small organization and I'm in massive growth, like, how do you guys evaluate if this company have the right board? What does that conversation look like? Thank you for all your support to our channel. Here's a quick word from our sponsor. Please click on the link below in the comment section to sign up for a demo with Track AI.
What if your insurance sales conversations could work harder for you? Meet Track, your AI-powered conversation intelligence partner. Track automatically captures and analyzes every customer interaction, providing instant call summaries, risk analysis, and AI-driven coaching insights. Say goodbye to manual note-taking and hello to more selling time. Track handles the admin work while you handle the revenue. Fully integrated with your favorite platforms. Plus, get custom AI analysis tailored to your unique business needs. Transform your sales team's performance with Track. Visit track.ai today.
Click the link in the description below to schedule a demo with Track today.
A couple of things. Great question. One is, from a board perspective, making sure that if it's an audit committee, that they've got the knowledge and experience to be directing the audit of that business. And so they've got, knowledge about financial statements, but also just have maybe a CPA background. So it's going to be a good person for the audit. Nomination and governance, making sure those board members have the requisite experience as well. Same with compensation committee. It really comes down to what is the board member's experience and how does that help the business grow? Because the board members will guide the business. The management will be the ones in the boat steering the business. And so, you're trying to make sure that the board members, understand the business, understand the headwinds in the industry, and can make sure that they can, help connect and really be that guide for the C-suite as they're looking to grow the business.
Are you guys making introduction as part of that deal as well? When somebody come to you and say, hey, I know so-and-so could be a great board member for you guys. Do you guys do matchmaking as well?
Yeah, all the time. I've got a number of, connections. We work with a lot of clients where great board members, a lot of these guys become friends of mine as well. And so, happy to, put them in front of others or ones I meet over time and build that trust with them, and would be willing to show them over to companies looking to really get an advisor there as well. It's not a service provider like myself, but it's a trusted advisor for the company, somebody they can rely on. Because look, at the end of the day, they're putting their trust in a board member that they're really going to consult with quite a bit and hopefully steer the ship the right way.
So basically, they become a high-paying consultant with a higher upside.
And the little words, yes, that's right. I think they do a little bit more in consulting, but they are ones that lend their credibility via their experience to the business, and really been there in the trenches and understand.
Yeah. And then some fiduciary duty to oversee. I'm gonna pivot for a second. You know, some of the specs has not done well the last 2 years, whether it's capital market, macroeconomics, or just the insurance in general, the loss ratio, right? The reinsurance has been tough. What do you think spec gonna look like in the next 5 years? I know that's
Well,
a
I think we're
big
gonna.
question.
Yeah, no, it's fine if I put my prognosticating hat on. I do think in 5 years you're going to have 30 to 40 stacks per year, maybe a little bit more. They're all going to be kind of sponsors that have had multiple stack deals done, and so you're going to have pretty experienced teams. And I think the terms are going to be what they were in 2020 as opposed to what they were in 2022, meaning overfunding the trust won't be as prevalent as it was sort of 2022, meaning SPACs would come out at $10 a unit. Each unit would consist of some form of warrant as well as the stock itself. And that overfunding meaning that they would pay an additional 2, 3, 4, 5 cents on top of that $10. So the sponsor would put in an additional amount of money, 0.5%, into the trust, so that it's gaining the interest or whatever the money is in trust, getting a return on it. And so I think a lot of that will go back kind of normalized because won't have as many, and so they'll continue to be in the 40, 50 range. I think from an industry perspective, they'll be all over the board, including insurance. You've got consumer goods. You've got ones that will be in technology, potentially energy, and so those would kind of focus. And then you'll have both non-U.S. as well as U.S. Tax.
That's a new question I haven't thought about. Do you guys work with many companies outside the US trying to come into US to become public in the insurance world?
Well, there hasn't been a lot on that. We've had a couple of discussions on that, but I do think there is a possibility of that.
Interesting. So-
Regulation will be, some of the barriers to get in. There always are in the insurance sector, but if there's a way to make capital, people will do it.
Yeah, at the end of the day, there's so much capital here in this country. Put on your magic wand, your crystal ball for a second. The new administration coming in, they talk about less regulation to incentivize and inspire the capital market, the private market. How would you make any change that you think could be if Trump and Elon and JD Vance call you today, say, "Hey, Michael, we're drafting you in the first round to come join the ship. We need expertise. Help us figure this out. How to encourage more growth." What would you do?
Well, I certainly would reduce the amount of regulation that's out there. That's coming from a lawyer. I'm not a regulatory lawyer, but a lot of lawyers do make their business on that. I think the way they try to do it before 2 for everyone, it's probably not going to get you much because these regulations pop up all the time. I would focus on really where industries that make a difference to growth. And so you have to look at energy, you have to look at insurance, to your point, and make sure that those are in line. Like, you need smart regulation. You don't need over-regulation. And I think these sectors can be smartly regulated. I mean, you want clean air, you want clean water, you want land to be free and clear. You want no one taking advantage of anyone in the particular sector. So you have to be able to have the right type of regulation. So I don't know. I'd take an audit of the regulations out there. There's so many. Man, there's 90, 100,000 pages worth of them per sector or something. Wild. But from a capital raising perspective, I think I'd go back and look at the Sarbanes-Oxley 25 years later, see what kind of effect, if that's been helpful from an audit perspective. Look at the Jobs Act of 2012, see if there's any improvements that we can make to that to foster capital growth. certainly would go back and likely scrap the climate change rules and do that smartly and not require necessarily on the top financial statements. So there's a number of things I would look at that are potentially overburdensome to some, that are making it a little bit more difficult to operate. So
Are you familiar with the QOZ, the
a little
opportunity
bit of
funds?
familiar.
Yeah,
A
I
little bit.
wonder if there's anywhere they can make some modifications to the tax codes to drive more money into the funds and in the capital market.
They definitely could. I don't know how you force the financing of that, but I think if there's a way to show the tax credits, tax incentives are there. Like we have a tax code system that's driven a lot by incentives that people looking at the easiest way to get around stuff. And so if you can simplify some of that, I think it'd be better as well.
I talk so much about specs and IPOs, but what are other services that your firm expert in and offers?
We do technology, new media, so digital assets we've been working on. Work with telecommunication companies, work on telecommunication deals. In the energy sector, doing all different types of energy stuff, renewables to transition to traditional. And then healthcare and life sciences, we do a lot of biotech transactions as well as, healthcare deals for hospital systems and others. So those are kind of the heavy hitters for us. We also work with financial services, banks, broker dealers. Those are those are the four big industry sectors that touch on as well.
That's pretty cool. And being in the Houston area, I guess you always work with energies, right?
I didn't start my career there, but being here in Houston, the energy capital of the world, as they like to say, I've worked on a number of energy deals.
There's as I'm recording of this podcast, November 18th, there was a new show just came out on Paramount Plus. It's
Landman,
called
I saw it last night.
Landman. You saw it last night?
Yeah.
That was good. My wife
I saw the first episode.
We were hooked right away. We love Billy Bob Thornton, so
I mean, it's funny. That first scene was like crazy. So
it was crazy.
You talk to Landman down here, they don't deal with drug dealers, so I don't think it's pretty typical. Without giving away the show, but it's not a typical thing to happen in West Texas.
Yeah. Oh man, I want to talk to you about that show because it was just so funny how he was like, "You don't want to mess with us."
I mean, it is true. All
show.
the ownership of land and get complicated. And actually, in a type of insurance, title insurance, that's why it becomes very complicated because you get all this ownership of the various, land, the surface rights versus mineral rights, and everything.
Is that when you watch the show? Is that like reminiscent of your past deals that you worked on, or
that there's a little bit of that because they show the ownership and then who's doing the leases and payments and stuff. But I was never a landman, but we do have a number of folks that have been landman in their past, and you hear about that. They're trying to make it like that.
How realistic was it that they deal with like accidents, blowout, lawsuits,
all the time?
all
Well,
the time?
the landmen don't. The landmen don't deal with the blowouts, but those things do happen. The blowouts. There are things that come up. Well, they get insurance as well.
Yeah. So that brings a good point. When you're working with your founders who are trying to go down that path, what are some of like the biggest landmine that you're trying to navigate them away from before they have their biggest day ever?
From the oil and gas sector or just in general?
Both. Let's start with the insurance sector.
Yeah, I mean, you have to understand the business you're getting into. I think that's number one, and make sure you understand the barriers that can be part of it, because you have to make sure you have enough capital and runway to deal with the business and things that can come up. I think those are the biggest traps, because sometimes undercapitalized businesses can be very difficult to navigate.
Would that be the biggest?
I think that's the biggest trap, because you can be an expert, but if you're not capitalized properly and have a real plan for the future, it can be very devastating, because makes, going forward very difficult.
Do you guys also offer classes, trainings for like C-suites to how to navigate being a public traded company?
We do. So we'll, help them think through being public and go through various issues that may pop up and sort of the solutions that we see.
Well, that was a lot of information, good information. And I really appreciate you coming on the show. And I'd love
Yeah.
to get you on maybe Q2 of next year and then just have like a reflection, look back period of, first half 2025. And maybe even do like a panel speaking of a couple people just reflecting on first half of 2025.
Yeah, I'd love to do it anytime. Thanks again, Chuck.
Yeah, thank you for coming on the show, Michael.
My pleasure.